Okay, let's unpack this. Welcome, everyone, to the Deep Dive. This is where we cut through all the noise, aiming to get you truly well-informed and fast. Today, we're diving deep into something, well, absolutely critical. It's the intricate world of financial regulation here in the UK. We're going to explore how financial firms and the individuals working in them are overseen, to ensure a system that's both safe and trustworthy for everyone involved. Our mission, simple, really, to take what can seem like incredibly dense, complex information and distill it into clear, actionable insights for you, giving you that aha moment without, hopefully, the overwhelm.
Absolutely. And what's fascinating here, I think, is how the Financial Conduct Authority, the FCA, they're not just aiming for these big, broad objectives like, say, market integrity. They're really getting down to incredibly specific details about who does what and how, every single person is held accountable. It's about building this framework that's so robust, it tries to anticipate problems before they even properly start, all in the name of protecting consumers and maintaining stability.
Exactly. But by the end of this deep dive, you, our listener, should have a really crystal clear understanding. First, of the sheer breadth of regulated activities and investments in the UK, you might actually be surprised by just how comprehensive that list truly is. Then we'll pivot to the Senior Managers and Certification Regime, or SM&CR as it's known. We'll delve into the pivotal roles and responsibilities of senior managers and also certified individuals, and those critical fit and proper requirements they absolutely must meet. You'll also discover how the FCA strategically categorizes and supervises firms to manage risk effectively. Plus, why ongoing training and competence are just non-negotiable in this industry. And crucially, the sharp teeth of the various enforcement and disciplinary powers the FCA wields when rules get broken. Here's where it gets really interesting. We can uncover the layers of rules designed not just to protect your money, but to ensure the people handling it are genuinely up to the task every single day. So let's kick things off with a fundamental question, one that might surprise you with its scope.
What exactly counts as a regulated activity or a regulated investment in the UK financial services sector? The Financial Services and Markets Act 2000, FSMA, seems pretty unequivocal on this. Basically, if you're undertaking a regulated activity as a financial services business, you need authorization from either the FCA or the Prudential Regulation Authority, the PRA, unless, of course, you're specifically exempt.
Right. And if you don't have that authorization, it's not just a slap on the wrist, it's a criminal offense.
That's a crucial point. And the scope, as you said, is astonishingly broad. When we talk about regulated activities, we're not just looking at the big high street banks. We're talking about things like accepting deposits, sure, but also managing investments, advising on them, even advising on and arranging mortgages or non-investment insurance. It goes pretty deep. It extends to setting up stakeholder pension schemes or dealing in and arranging various investments. What's truly insightful here, I think, is how this immense breadth reflects the FCA's view that almost any interaction where your financial future is touched, no matter how seemingly small, really warrants oversight. It's about trying to close every potential loophole where consumers could be harmed.
That makes a lot of sense. Connecting it back to that core mission of consumer protection. And it's not just the activities themselves, but the investments too. When we say regulated investment, what kind of products are we actually talking about? Is it just, stocks and bonds?
Oh, not at all. The FCA broadly describes two main categories here. First, you've got your traditional securities like shares, debentures, government gilts, that sort of thing. But then there's this other category, contractually based investments. And this covers things many people might not immediately think of as heavily regulated, like life policies, personal pensions, complex derivatives such as options and futures. The specific list is, quite extensive. It goes from mortgage contracts and electronic money to various insurance contracts, including, get this, even funeral plans.
Funeral plans.
Really, funeral plans. It's that deep. It truly underscores their commitment to overseeing the entire spectrum of financial products and services that impact individuals' lives.
Wow, funeral plans. Okay, that really drives home just how comprehensive the reach is. So with that massive scope of regulated activities in mind, the next logical question is, who exactly is held accountable when things do go wrong? And that brings us directly to the Senior Managers and Certification Regime, the SM&CR. A system, as I understand it, born from crisis and really designed to pinpoint individual responsibility. What's its core purpose and how does it sort of organize firms and the people within them?
Yeah, you're spot on. The SM&CR was a direct, quite forceful response to the criticism regulators faced after the 2007-09 financial crisis. Its core purpose is to embed an individual accountability framework right across the entire financial services industry. Moving beyond just holding the firm responsible, which was often the case before, the FCA notably extended it to what they call solo-regulated financial services firms, Basically, those not solely regulated by the PRA, covering a huge swath of the industry. And the regime cleverly structures firms into three tiers. There's core, which must meet baseline requirements. Then enhanced, for firms seen as posing the greatest potential risk to consumers and markets, they face additional, more rigorous requirements. And finally, limited scope, which are firms largely exempt from some baseline requirements because their impact is considered smaller.
Okay, so it's tiered based on risk.
Yeah.
And it's about making sure the right people at the right level are held personally accountable. How does the senior managers regime, the SMR part, specifically work then? What does it actually demand of those top-tier individuals?
Right, so the SMR, the senior managers regime, zooms in on individuals in these really key decision-making roles. These are known as senior management functions, or SMFs. Think roles like the chief executive, an executive director, maybe the partner overseeing a critical area, compliance oversight function holder, or the money laundering reporting officer. Crucial roles. These are the roles seen as absolutely vital to fostering good customer outcomes and market integrity. Now, before an individual can even step into an SMF, they have to be pre-approved by the regulator, which is a significant hurdle in itself. They also have to provide a very specific statement of responsibilities detailing their exact duties, and crucially, there's a statutory duty imposed on senior managers. They must take reasonable steps to prevent regulatory breaches within their specific area of responsibility. And if they fail to do so and reckless misconduct is found, well, the penalties are incredibly severe. We're talking potential prison sentences or even unlimited fines.
Reckless misconduct. That sounds like a very high bar, but yeah, with extremely serious consequences. Can you elaborate a bit on what that truly means in practice? It sounds like it's more than just making a simple mistake.
You're absolutely right. It's far more than a simple error or bad judgment call. Reckless misconduct isn't just about messing up. It implies a severe disregard for regulatory obligations, maybe a willful blind spot, or even a conscious decision that could foreseeably lead to significant consumer harm or market instability. It's that deliberate negligence, that sort of turning a blind eye to known risks, that triggers such extreme potential penalties. And to help with clarity, especially for those enhanced firms we mentioned, they also have to maintain a responsibilities map to clearly identify who is responsible for what across the organization, which is, a massive undertaking in itself, but crucial for this clarity.
That sounds like a powerful deterrent, definitely. And a clear shift in focus from just the firm to the individual leader. How does the certification regime then differ from the SMR? Is it for different types of roles within the firm?
Exactly. The certification regime covers individuals in, let's say, more junior roles compared to the senior managers, but whose actions could still potentially cause significant harm to the firm or its customers. Think proprietary traders, client-facing financial advisors, or maybe anyone supervising a certified function who isn't themselves a senior manager. The key difference here is that these individuals don't require direct, upfront approval from the FCA. Instead, the responsibility falls squarely on the firm itself. The firm is responsible for assessing and certifying annually that these individuals are fit and proper to perform their roles. And this certification isn't just a one-off checkbox exercise. It must be assessed on an ongoing basis. It's a huge responsibility placed directly onto the firm's shoulders.
Right, so the firm essentially becomes the gatekeeper for those certified roles. Makes sense. And what about this code of conduct that gets mentioned? Does that apply just to these certified people and senior managers or more broadly?
The code of conduct. It sets out the overarching standards of behavior expected, and it applies very broadly, not just to senior managers and certified persons, but actually to most other employees within a firm too. The main exceptions are those in roles not specific to financial services, like, say, security staff or cleaners, ancillary staff. There are two tiers of rules within the code. The first tier consists of individual conduct rules. These apply widely and include core principles, things like acting with integrity, acting with due skill, care, and diligence, cooperating with regulators, paying due regard to the interests of customers and treating them fairly, observing proper standards of market conduct, and crucially, this newer focus on acting to deliver good outcomes for retail customers. Then, the second tier adds specific higher-level rules just for senior managers, requiring them to take reasonable steps to ensure the business they're responsible for is run effectively, that it complies with regulations, and that any delegated responsibilities are properly overseen. Firms are also explicitly required to ensure all relevant staff are aware of these rules and receive effective training on how the rules apply to their specific roles. It truly permeates the entire organization.
It sounds like it all hinges on individuals being deemed fit and proper then. That phrase comes up a lot. What exactly does that entail? And how does the FCA really assess it? Or, expect firms to assess it? Because fit and proper can sound quite subjective on the surface.
It's a crucial concept, absolutely central. And while it might sound subjective, the FCA actually lays out very clear criteria across three main areas. First, there's honesty, integrity, and reputation. This is judged by looking at factors like criminal records, any past disciplinary proceedings, past regulatory contraventions, complaints history against them, any issues with insolvency, or even previous dismissals from employment. Second, there's competence or capability. This means meeting the FCA's specific training and competence requirements, which we can talk more about, possessing relevant qualifications, undergoing proper training, and demonstrating a relevant degree of expertise for the role. And third, there's financial soundness, which is indicated by their current financial position or perhaps any history of bankruptcy or significant adverse credit ratings. Now, for those senior management functions, particular consideration is given to their qualifications and, importantly, extensive relevant experience. What's really impactful here is a requirement introduced with SM&CR. A new employer must request and check references covering an individual's past 6 years, specifically looking for any disciplinary action related to conduct to ensure they are truly fit and proper based on their verified history. And this information, by the way, is also publicly reflected on the Financial Services Register, making transparency a key part of the system.
That makes a lot of sense, particularly with the strong focus on accountability. You wouldn't hire a pilot who'd been found reckless, right? The FCA seems to apply a similar logic to those entrusted with handling your finances. Okay, moving on slightly. How does the FCA actually supervise the firms themselves? What's their general approach? Do they treat every firm the same way?
No, they absolutely do not treat everyone the same. Their supervision is guided by 8 key principles, really designed to be both proactive and proportionate. These include being forward-looking and preemptive, trying to address potential harm before it crystallizes, deeply scrutinizing firm strategy and business models to identify emerging risks. That's a big one. Examining a firm's culture and its governance, which, as we've discussed, is huge now. Reinforcing that individual accountability under SM&CR. They also maintain a proportionate and risk-based approach, meaning they focus resources where the risks are highest. They encourage open, two-way communication with the industry. They coordinate messages with other regulators like the PRA to avoid confusion or regulatory silos. And they aim to fix systemic harm when they find it, while also ensuring consumers are compensated where appropriate. It's a very holistic, almost diagnostic view, tailored to the specific risks each firm poses.
Okay, so it's about allocating resources strategically then. Not everyone gets the same level of intense scrutiny.
Yeah.
How does that translate into prioritizing their supervisory activity in practice?
Precisely. The FCA adopts a highly proportionate approach, as they call it, ensuring its resources are focused where the risk to its objectives, consumer protection, market integrity, competition, is greatest. Most firms fall into what's supervised as part of a portfolio. They're grouped with firms that have similar business models, and they're supervised through targeted work, thematic campaigns looking at specific issues across many firms, and educational initiatives. However, those firms deemed to have the greatest potential impact on consumers or markets. Think the large banking groups, major insurance companies, or firms with a very high number of retail customers. They receive what's called dedicated supervisory oversight. These firms are subject to the highest level of scrutiny. This involves continuous assessment. And they usually have a named supervisor at the FCA who essentially lives and breathes that firm's operations and risks.
Right, that's a very clear distinction and approach. You mentioned a 3-pillar supervision model earlier, I think. Can you elaborate on that and perhaps give us a feel for what each pillar really targets?
Certainly. The FCA's supervision model is often described as being built on 3 distinct pillars, each reflecting its ongoing analysis of industry risks. Pillar 1 is proactive firm or group supervision. This is all about getting ahead of the curve, as we said, spotting potential trouble before it starts by really understanding a firm's business model, its strategy, its culture. Think of it as preventative maintenance for the system. Pillar 2 is event-driven reactive supervision. This is more like the rapid response team, dealing with issues as they emerge, maybe a significant operational failure, a market event causing stress, or a major surge in consumer complaints about something specific. The goal here is to intervene quickly to prevent further harm. And Pillar 3 is issues and products. This is where the FCA takes a thematic approach, diagnosing and remedying actual or potential harm across a number of firms or specific product types, identifying systemic problems like perhaps widespread mis-selling of a certain product or emerging risk in new complex products, and then acting to stamp them out across the board. And regardless of the pillar, key areas of interest for the supervisors always include a firm's business model and strategy, its culture, its frontline business processes, its systems and controls, and its overall governance structure.
Culture and competence sound like really big parts of that framework, especially with Pillar 1 being proactive. So how does the FCA ensure firms are actually maintaining high standards of training and competence, or T&C? Because it seems absolutely vital to preventing issues from arising in the first place, doesn't it?
It truly is. And the FCA aims to be proactive rather than purely reactive here. They place immense importance on training and competence precisely because it's seen as a primary preventative measure against misconduct and consumer harm. There is a whole section of their rule book called the Training and Competence Source Book, or TC Source Book. It basically spells out what financial advisors, their supervisors, and even people involved in certain administrative functions like insurance underwriting, what they need to know and how they need to stay sharp and up to date. Ultimately, the firms themselves are responsible for determining the training needs of their staff and for ensuring timely and effective training is delivered. For initial competence, for instance, someone wanting to be an investment advisor cannot even start advising clients until they demonstrate an adequate level of knowledge and skill. Typically, this is done by passing specific regulatory module exams or other appropriate qualifications recognized by the FCA.
Okay, so there's a definite hurdle to clear just to begin giving advice. But once someone is deemed competent, how is that actually maintained over time? Because, markets change, products evolve, rules get updated constantly.
That's the ongoing challenge, absolutely. And maintaining competence is an explicit, continuous requirement under the rules. Firms must ensure their employees remain competent for their roles, and their competence needs to be reviewed regularly, especially when there are changes in technical knowledge needed, skills required, market conditions, or relevant regulations. Retail investment advisors, for example, have a very specific requirement. They must complete a minimum of 35 hours of continuing professional development, or CPD, every 12 months. And at least 21 hours of that has to be structured, learning things like attending accredited courses, seminars, lectures, or completing relevant e-learning modules. Not just reading the FT, there are also very specific record-keeping rules around this. For some roles, T&C records must be kept for at least 5 years after the person stops the role. And interestingly, indefinitely for pension transfer specialists, just to show how seriously this is taken, particularly in high-risk areas. Plus, retail investment advisors must obtain something called a Statement of Professional Standing, or SPS. They get this annually from an FCA-accredited body, which confirms they meet the required ethical and professional standards, including the CPD requirement.
Okay, all of that sounds incredibly robust, very thorough. Finally then, what happens when, despite all these layers of protection, the rules, the supervision, the competence requirements, things do go wrong? What kind of enforcement action can the FCA actually take against firms and individuals who breach the rules? What teeth does it have?
Yeah, the FCA does take action, and often quite decisively, when it finds that a firm's business model, its culture, or specific practices are likely to cause harm to consumers or threaten market integrity. An investigation can be triggered by various circumstances. Obviously, contravening regulations, but also things like providing false or misleading information to the FCA, falsifying documents, or even allowing unapproved persons to carry out controlled functions they shouldn't be doing. If a contravention is discovered, the FCA has a formidable arsenal of powers it can deploy, depending on the severity and nature of the breach. These can include varying or even completely withdrawing a firm's permissions to operate in the UK. That's a big one. Withdrawing an individual's approval to perform a controlled function, effectively kicking them out of that role. Issuing injunctions through the courts to stop certain activities. Ordering restitution, forcing firms or individuals to forfeit profits made from misconduct. Or requiring redress, making them compensate customers who have suffered losses. They can also take quite severe disciplinary action. This might involve imposing significant financial penalties. Fines can run into the millions, or even hundreds of millions for large firms. Issuing public statements of misconduct, which can be incredibly damaging to a firm's or individual's reputation. Or suspending individuals from working in the regulated financial services industry, either temporarily or permanently. And for firms identified with serious governance or cultural failings, enhanced supervision is another tool, leading to much more stringent requirements and constant oversight until significant improvements are demonstrably made.
So what does this all mean for you listening in? We've covered a significant amount of ground today, really revealing the intricate layers of regulation that govern financial firms and individuals here in the UK. From understanding what constitutes a regulated activity, even down to, yes, funeral plans, to the nuanced individual responsibilities under the SM&CR, It's abundantly clear that this is a pretty comprehensive system built on accountability and ultimately designed for consumer protection.
Yeah, and if we connect this to the bigger picture, I think the consistent emphasis on robust training, on continuous competence assessment, and the clear, strong enforcement powers of the FCA, they all underscore a deep, unwavering commitment to maintaining public confidence in the financial system. It's really about cultivating a transparent and responsible environment where integrity is paramount, ensuring not just box-ticking compliance with the letter of the law, but genuine fair treatment for customers in every single interaction. This isn't just bureaucracy for its own sake. It's arguably the bedrock of trust in our financial system.
And this perhaps raises an important question for you to consider as we wrap up. Given the constant rapid evolution of financial markets, thinking about the rise of new technologies like AI and blockchain and emerging services that often cross traditional boundaries, how might the SCA's supervision model and its approach to individual accountability like the SM&CR need to adapt in the future? How can it keep pace with all this innovation while still upholding its core objectives of consumer protection and market integrity? What do you think is the next frontier for financial regulation? Something to ponder.